for your time. The news from the energy markets is, I think, going to be in play today. We got the OPEC Plus meeting, and we got this pipeline issue. So Europe pretty much left in the lurch because of this. What do you make of it in terms of the impact?
Well, I think OPEC Plus has to be careful because if they cause energy prices to go up again too quickly, it's going to obviously depress the global economy. And the global economy has a tremendous amount of challenges. We know that the European economy is almost inevitably going to be in a severe recession related to the energy crisis. China just still seems to have a lot of problems with managing the COVID pandemic. And on top of that, they've got a housing bubble that continues to lose air. And then the United States, I think, is experiencing what I would call rolling recessions, hitting different sectors at different times. Right now, it's hitting the housing recession, so causing a housing recession. So I think OPEC Plus would be well advised to be very cautious about cutting back on supply too much and pushing prices up too high. Because as we've seen, people do respond to higher prices by cutting back.
Okay, Ed, good morning. The debate was on the jobs data, right? A lot of people called it Goldilocks. The market celebrated. Then maybe by close we found out that maybe the celebration was a bit premature. But your thoughts in general, looking at the numbers and whether that changes anything.
Not really. I mean, they were good numbers. And sometimes good news can be bad news. I think it basically was strong enough so that the Fed will, in fact, proceed with a 75 basis point hike in a few weeks at the next meeting in the FOMC. As you folks pointed out, there's still that September 13th CPI to come out. I think it's going to be a remarkably good number. I think it could be 0 or slightly negative because we know that gas went down a lot during the month of July. We know that car prices have come down and that other prices have been moderating. If I'm wrong and we get a surprisingly high number, then I think the Fed's going to go for 100 basis points on the Fed. I think that's why the stock market did not react. Initially reacted very well to those numbers, but then on second thought, there was a recognition that, well, that's behind us now. What's ahead? And what's ahead is the Fed's commitment to bring inflation down. And as Mr. Ferguson said, the inflation rate remains way too high, way too much above 2%.
Actually, what started in March embarked on what has now become the sharpest round of rate hikes by the Fed since the 1980s, right? And I think that has caught a lot of people perhaps off guard. They wouldn't have expected the intensity of the rate hikes to be so soon and so high. So in that context, Ed, what do you do with equities as an asset class? Because since Fed Chairman Jerome Powell's speech, most U.S. markets are already down by about 8 to 9%. Do you think the worst of it is in the price, or is there more to go?
I do think we made a low in the bear market on June 16th. I know that's very controversial now that the market's back down. The bears are growling that we're going to fall below that. Maybe that they've been talking about 3,200, 3,300. I think sentiment was so awfully negative on June 16th that I think anybody who wanted to sell probably sold by then. And so I think we've kind of seen the exhaustion selling going on. I think this week will be important. I think this week we may very well make a low for this move. I think we're going to be in a range for a while, a trading range for a while. And I think the portfolio strategy is most investors who are in stocks know that they're in it for the long haul. It's very hard to trade them. It's very hard to play corrections. I mean, I've seen plenty of people who told you exactly the right point to get out of the market and then forgot to tell you about when to get back in. So by the time they told you it's okay to get back in, you're back to where kind of you started. Meanwhile, you missed some dividend payments and all that. So I think the bear market's over. I think we're going to be in a consolidation phase here. We're not going to go straight up for the stock market. But I think on a global basis, there aren't too many safe havens for investors. And the United States continues to look attractive, as we can see by the strength of the dollar. And by the way, as you mentioned before, I agree with Chris Wood that money is going to leave China and go to India, and that may continue to also support the Indian market.
Oh, yeah, that's been I mean, we've discussed that at some length here.
Sure.
Ed, just to stick to that global point, though, many believe that what Fed Chair Powell said at Jackson Hole actually is a pretty significant turning point. Some even said the reason why that was so short, he kept it to 7 or 8 minutes, is because he just wanted to say exactly what he wanted to say and did not want people to pick up other stuff and interpret it in any other way. So just, I mean, very, very focused messaging. With
You're
that,
absolutely right.
Yeah, sorry, go on. I mean, so if that is significant, I mean, how can we be so sure that, the worst of this financial conditioning tightening phase is behind us?
Well, if you look at what he said in his press conference at the end of July, it was it was too much off the cuff. It was not scripted. It was not prepared remarks. It was what he responded to in a normal Q&A fashion. But the problem is that he talked so much about so many things that you could almost come with any conclusion you wanted to. And for some strange reason that I still can't fathom, the market seems to have concluded that on balance, he was saying that the Fed would start to be easier next year and that the pace of tightening would start to slow. And that's where he really felt he had miscommunicated and wanted to make it very, very clear that the Fed's number one priority is to bring inflation down. And I think you're right. I mean, that's why he kept the speech to 8 minutes. He was very specific about what he said. But when I look at the press conference and I look at what he said, in both instances, he said, if you want guidance, look at the FOMC's, the Federal Open Market Committee's guidance provided in the summary of economic projections. And that very clearly showed that the FOMC expects the Fed funds rate to be at 4% by the end of next year, or very close to 4%. And so he wanted to remind everybody that whoever got the impression that they were going to stop pretty soon and start easing next year, that was just wrong.
Just one final comment on the energy crisis that's blowing up, right? Especially in Europe. I mean, benchmark electricity prices have surged 300% this year. What are the implications that this would have on global equities, especially perhaps emerging market equities?
Well, I think you're very right about this crisis in Europe. It's a great concern. Even if they are able to get the gas for the winter, the next question is, then what? I mean, clearly you want to get through a winter season as best you can, but you also want to make sure you have energy on a longer term basis. So it's taking a while for them to line up all the alternative sources of energy. I think for the emerging markets, the main issue is the Fed, as it typically is, and the Fed is committed to tighten. It's a strong dollar, which means that their currencies are weak. Commodity prices look like they're starting to weaken. So I think, generally speaking, the emerging markets portfolio tends to be very much influenced by commodity prices, and those prices have been weaker. And of course, the strong dollar is also bad for commodity prices, and therefore bad for emerging markets. But I think the emerging markets as an asset play, now investors have to be much more picky about where they go. And I just don't think that, it's either emerging markets or developed markets. I think in this case, you don't really want to be in Europe. You want to be in the US. You don't want to be in China. You want to be in India. And the more commodity-related countries like Chile and Brazil, maybe those also need to be avoided right now.
All right. Well, Ed, we leave it at that. Thanks a lot for joining in. Always good to hear some positive opinion coming through on India. So that's Ed Yardeni saying